Good morning, everyone, and welcome to the Moneycontrol live stream. You're watching Markets with Santo and CJ. Well, there is a lot to digest, a lot of earnings from yesterday, a lot happening in the global macro environment as well as in India as well. But in the spotlight today, we want to talk about metal stocks. Yeah, if you have been tracking the market for the past week, you have noticed the Nifty Metal Index has surged sharply, and it has taken a few of the speculators out there by surprise, largely because yes, the initial bit, Santo, I do give you probably just short covering happening in the market.
I didn't say that yet.
No, but I know that argument will come in from you that
it is just my argument.
It is just speculative. But I mean, hear me out. You know, I think one of the reasons what is fundamentally driving the rally that we are seeing in metal stocks is the news flow that is emerging out of China. We know that the week before last there was a screenshot that was roaming around the markets in China, in Asia, that possibly China may look at ending its COVID-0 policy, and that is where the real rally started. And then in subsequent days and weeks, although China has overall denied that they are not going to abandon their zero COVID policy, but the recent change in certain COVID measures and norms have led to a signal, or have given a signal to the market that China may probably be taking its foot off the pedal. And that is a good news because China is the biggest commodity consumer. Yes, it is also the biggest commodity producer, but is largely now seen as a bigger commodity producer. Plus, if the property market in China does come back, that will also be a very, very strong signal that demand for commodities may start rising. Now, yesterday, certain investment banks in US also came out with a report suggesting that inflation in US may fall quite drastically because of the Fed's action in 2022. And therefore, a recession in the US may actually not be as bad or as deep as a lot of people have been fearing. If we have a shallow recession in the US as well combined with a recovery in Chinese economy, then that is a very, very good setup as far as the metal stocks are concerned, Santo.
Well, CJ, a quick point here. The supposed cooling off of inflation probably seems to be now flowing in through the labor markets, and which is also what the Fed had been targeting for some time. Now, if you look, first it was Twitter, which laid off people by the thousands. Next came Meta, and now Amazon. According to reports, they are planning to lay off around 10,000. So all this means that purchasing power will definitely go down unless the labor market continues to remain fast at this rate. But if the big companies are firing, obviously there's going to be a glut of labor. Okay, so the shallow recession that people are talking about exactly at this point in time, I'm not so sure how that will play out and if there will indeed be a soft landing. Secondly, whenever there is a recession, it's always invariably commodity prices do tend to cool off. Demand for commodities goes down. And now you're making the point about China reopening. Now, China reopening, it doesn't just mean that it will only consume. Remember, it also produces and exports. So we saw that in the case of aluminium. So we'll have to look at metals slightly differently. Steel versus aluminium. I don't think you can just lump them all together at this point. There are different dynamics at play. Steel companies don't seem to be in a very good spot at this point in time, even though the domestic market is holding up well. If you look at the management commentary, again the realizations don't seem to be all that strong. Of course, there is also the drag in the form of the export tax, because of which companies are not exporting. But at the same time, let's not forget that demand outside India is weak. At least Europe has been a major drag for Tata Steel, as we saw from the latest set of quarterly numbers. There's not much demand in those economies. So it's not a very pretty picture. Now let's look at commodity prices, for instance. Aluminium and any other nickel, each of those. The price of peak that you saw around March, just when the hostilities between Ukraine and Russia had broken out, we are not seeing metal prices go back to those levels, right? So some bit of pessimism on all the commodity stocks, notably I'm talking about steel and aluminium here, probably could have been overdone. You saw sharp correction. From there the stocks bounced back a little bit, short covering and many other reasons. The outlook at this point in time doesn't look so bleak so as to warrant a very sharp fall in commodity prices, but we still don't know how that will play out. So if the downsides are limited, CJ, I would think that so are the upsides at this point in time.
I think, Santo, if you look at commodity prices and you talk about, recession fears, market will not, of course, wait for the recession to come knocking on the door. It would already anticipate that, and we've already seen that in the crash in many global commodities. You talk about copper, you talk about aluminium, nickel, lead, almost zinc, of course. all of these commodities are probably down about 20 to 25% from the record highs or the highs that multi-year highs that they had hit back in 2021 and early parts of 2022. But my feeling is here that, you know, the other thing that could aid besides the demand environment is the fact that there are two things that people need to remember. Prior to COVID, there was, of course, talk in town that commodity could be a good cycle to invest in, largely because there is a humongous amount of underinvestment as far as many commodities are concerned, and of course that is encapsulated in oil prices that we are seeing. Oil prices we are not used to, at least the past decade post 2014 crash. We have not seen oil prices still hover above 80, 85. When they have tended to reach those levels, there was always a glut of supply coming in from the US, and you saw a balance in the market. But now those sort of situations do not exist, largely because the world is trying to transition towards more sustainable energy forms. I think that is where supply being probably not being able to match demand, even at current levels, which are apparently, you know, a little distressed. If demand does come back in a big way, I think prices ought to move higher. The second factor is that you have to look at the dollar's role in this as well. The strength in the dollar this entire year has also played its part in the weakness of commodity. We know that the dollar's price and the commodity price are generally inversely related. Because of that, if the dollar does climb down from here on, and we see the dollar probably inching towards the 100 mark, maybe 95 mark going ahead, that itself should also enable a good short-term boost for commodity prices. So I would not say that this rally that we are seeing is entirely speculative. Yes, there is probably we are hoping for some sort of a miracle, but there are at least signs that that miracle can be achieved.
Well, I'm not sure if, yeah, there's a good linkage there between the dollar and commodity prices that you have pointed out, but at the same time, cooling off of the dollar index or the slight weakening of the dollar in itself, I'm not so sure that how it will increase demand for commodities.
It always makes it, you know, cheaper for importing nations to always import, because they have to import it in dollar terms. So whenever their currency always appreciate, it always becomes cheaper for them to, you know, import, and especially for a commodity, you know, consuming and importing nation as we are. For us, definitely, and for many of the developing world out there, it always makes it easier. But of course, the caveat here being that demand should be there.
Exactly.
It's not just that,
CJ.
but you know, in India, for example, you take India for example, the reason people are buying banks is the fact that everybody is, you know, counting on the golden era returning for private investment and capex. Now, if you don't believe that commodity price demand is not going to be there, you cannot therefore believe that there is a capex recovery on the anvil. If there is a capex recovery, there will be demand for steel, there will be demand for cement, there will be demand for copper. So those they are not mutually exclusive. They are mutually inclusive, and therefore that is where I feel that at least in developing markets you could see good demand, even if the developed market sees some sort of slack, especially Europe. Maybe US will get out of it, but Europe is of course the major concern. But I think the rest of the world, if China does come back, could bring demand back to the levels that we were seeing in 2021.
We're a bit out of time here, CJ, but I will definitely like to take that up with you for a later time.
Absolutely, Santo. That said, let's quickly look at the setup for trade today, and it is looking a little bit of a positive start after the very lackluster day that we had yesterday. The SGX Nifty futures are indicating a positive start for our market. That is, of course, on the back of quite a favorable CPI print coming in for the month of October. If you look at CPI inflation in India in October, it was about 6.77%. as against 7.4% in September, although the October's number were slightly above what the market was expecting, but I don't think that is going to bother investors at this point of time. Anyway, nothing is bothering Indian investors these days because they seem to be climbing all sort of walls of worry. That said, the handover from Wall Street, of course, was a little negative. If you look at the benchmark indices there, they did end in the red territory, largely because of a late sell-off in technology stocks.
Well, the gains from here on, CJ, it looks like they would be a little more gradual. You've seen a good run-up, and one of the factors for that is the sharp drop in the amount of DII buying. They've been sellers for most part. Now, last few days they've been buying, but the quantum of purchase is very small. So, we're not getting enough support from domestic institutions the way we had been. So, it looks like domestic investors, that seems to reflect that domestic investors more than anybody else don't seem to be very convinced at that point. It's a bit of a contradiction.
I think they're probably booking profits, Santo, given the fact that during that phase when FIs was selling, they were the big buyers in the market. So because they were buying when prices were going down, they are now booking profits, it seems, when prices are going higher, driven, of course, by the return of foreign investors.
Possibly
perhaps.
also more redemption requests. Quick check on the FNO market here. Now, some bit of short covering seen in the futures of Dr. Lalpath Labs, Manappuram Finance, Deepak Nitrite and Navin Fluorine. All the results in the case of these companies were just about average. We are seeing long build up in futures of Hindalco. That should make you happy, CJ.
Thank
also,
you.
United Breweries and Abbott India. The short build up seen in Sun TV, where the numbers were quite disappointing, and also Bharat Forge futures.
Well, thank you, Santo, for those FNO cues. Now moving on to the newsmakers of the day, and the first up for me, of course, is from the commodity space again, is ONGC. The company came out with its earnings for the September quarter, and while, of course, if you look at the numbers sequentially, they would seem disappointing in the back of course, the government imposing a windfall gains tax or the special additional excise duty that was imposed on crude oil production. But in general, I think numbers have been largely in line with what the market was expecting, a 30% downtick on net profit on a year-on-year basis, but sales surged 57% from the year-ago quarter. Also, very importantly, crude realizations at about higher by about 37.7% in the territory of $90 per barrel. So that is very, very impressive given the fact that at current prices, market is only expecting average crude realizations of barely $40 to $45 per barrel. So that is clearly indicating that the market is, at this point of time behind, or maybe just too pessimistic as far as ONGC is concerned. Also, gas realization shooting up to 41%, of course, aided by the fact that government had raised APM prices or administered gas prices back in April as well as in September. So that is aiding the realization on the gas side, Santo.
Well, the Biocon is my newsmaker. Again, the stock is likely to be in focus because of its second quarter earnings. Now, net profit was down about 48% year on year, but that's largely due to higher rate of taxation, about 64%. If you look at the revenue, it has in fact gone up by close to about 27%, and operating profit has gone up by close to about 7%.
Well, Santo, your hot brokerage bet of the day?
I'll start with JK Cement by Antique. Antique has a buy rating on the stock, and in fact it has upgraded its price target for JK Cement from 3,300 to 3,450 rupees. Now, according to Antique, the standalone operating profit has been fairly robust and slightly ahead of what the market was expecting. Besides that, the company has been able to increase its market share without compromising on profitability. Now, in the case of most cement companies, CJ, we've been actually seeing a downgrade in earnings estimates. So this is among the rare companies. In fact, Antique has upped its EBITDA estimates for JK Cement by about 1 to 3% for FY24 and FY25.
I think Santo, JK Cements, I think, has been one, outperformance that has caught the market by surprise. Clearly, their earnings performance as well as the stock has been doing quite well recently, defying the trend that we are seeing in the cement sector.
Well, a quick take on the market before we move on to the next brokerage pick. Nifty is up by about 35 points in early trade. Strong market breadth once again. 1,350 stocks are up, close to about 500 stocks are down. Nifty mid cap is flattish. Nifty Bank up 0.4%. We are seeing some bit of strength there. ICICI Bank among the early gainers. So the SBI, both stocks are a little over 0.5% higher in early trade.
And I think if you have to look at the small cap index again, Santo, clearly after yesterday's outperformance, the Nifty small cap index higher by about 0.2%, outperforming most of the market at this juncture. And sectorally, if you look at Nifty Bank doing quite well, Nifty FMCG also doing quite well in the morning, as well as Nifty Auto. So a lot of the consumer names are doing quite well, and the Nifty Metal Index, however, I think is up about 0.2% at this point of time, or 0.4% now. So clearly continuing on the gains that it has been seeing for the past 4 to 5 sessions, Santo. Well, coming back to brokerage bet, Santo, my brokerage bet of the day is GR Infra Projects. This is a report coming out from Keystone Capital, who have initiated coverage on the stock with a buy rating and a target price of about 1,510 rupees. Now, their point here is that they are quite liking the fact that GR Infra Projects is trying to diversify its revenue stream and focus also on non-road infra projects. Currently, GR infra projects revenues are largely dominated through road projects, but they are looking to diversify and get into other areas as well, which the brokerage believes is a step in the right direction. Apart from that, because of the fact that a large chunk of its road projects are hybrid annuity model based road projects, there is a possibility for margins to upscale from here in a very rapid manner in the going year, especially as order inflow improves for GR infra projects. And lastly, of course, Keystone Capital believes that any sort of asset monetization that may take place through the utilization of investment infrastructure trusts that the company could bring into the market, that could strengthen or give more muscle to growth of the company, because that will bring in cash and allow the company to grow going ahead and also improve its balance sheet. So, interesting stock to look out for in the mid cap and small cap space, and keep an eye out for it over the next 12 months.
Well, and with that, we move on to the stocks on our watch list this morning, starting with Narayana Hrudayalaya. Company's second quarter revenues were up close to about 21% and slightly ahead of what market was expecting. EBITDA margin has improved by around 21%, and this is despite the fact that losses at its St. Lucia arm has in fact widened. Now, overall, the Hyderabad facility now is doing pretty well at this point in time. It's both cash and EBITDA positive. The Mumbai facility continues to make losses, but again there also an EBITDA, it's expected to become EBITDA positive over the next 2 to 3 quarters. Now, the key triggers for the company is basically the strong ramp up in its India operations. Remember, Narayana Hrudayalaya also has operations in Cayman Islands and St. Lucia, but the main driver is going to be the improvement in its India operation and also increase in international patient flow, which will improve the average realization per occupied bed. Elara Securities is among the brokerages which is bullish on Narayana Hrudayalaya. In fact, it has raised its earnings estimates by 6% for FY23 as well as FY24.
Well, Santo, I would never understand why a hospital chain, hospital chain owner in India would want to open a hospital in Cayman Islands of all places. But well, we should not dwell deeper into that. That said, of course, this is one stock that has shown a lot of resilience in this market, although its returns are modest at about 12% for this year so far. But if you compare that to what has happened in the broader market, clearly it has been a stock that has shown quite a lot of resilience. And I think, Santo, given at this point of time, hospital stocks in general are quite in favor, because the general view in the market is that occupancy rates are going down. A lot of the newer projects that they had brought online over the past few years, they are now starting to sweat, or basically occupancy rates there are also improving, and therefore that should also aid EBITDA margins going ahead. So overall, the outlook looks quite strong as far as the hospital space is concerned. Well, in ancillary to that, of course, is the pharmaceutical space, and from this pharmaceutical space, Glenmark Pharma came out with its earnings not so long from today, and although the earnings did look quite strong on face value, but the outlook that the management has given, that has not impressed a lot of analysts. JP Morgan, for example, has suggested that the company's outlook for FY23 or the remainder of FY23 appears to be quite muted as far as growth is concerned. They have retained their sell rating on the stock, as they believe that the current pace of deleveraging that the company has been doing, and by the way, this has been going on for almost 3 years now, but the progress there has not been as as it was expected when the company first forayed onto deleveraging its balance sheet. So there are challenges at this point of time for Glenmark Pharma. Investors are not really happy with the slow pace of reducing its debt levels on the balance sheet, and therefore this could be one stock, I think, Santo, that could remain under pressure in the near term as well.
Well, the stock has been lagging for some time now, CJ, and this used to be one stock which had its heyday probably back in 2015.
Yeah.
At that time when the stock had hit a high of close to about I think 1000 plus. Since then it's been a long period of underperformance, and sometimes when stocks underperform for a very long period, that also in a way at times tends to slow down the further recovery, because people who have bought in at earlier levels, at every rise they try to get out. So that kind of plays it over a period of time. So in the case of Glenmark, yes, this quarter's numbers have been very strong, pretty strong, margins also pretty decent, but at the same time, it's a forward-looking guidance probably that the market does not seem to be very enthused about, and the price reaction of the stock over the past couple of months also seem to be pointing exactly in that
Absolutely,
direction.
Santo.
Apollo Tyres, the next stock on my watch list, again decent set of second quarter numbers. Now the top line has been in a range for the last 3 quarters almost, but more than rising top line, I would say that CJ, the bigger play here would be the improvement in margin. That is what is now maybe most likely to drive the improvement in the company's earnings at this point in time. Remember, crude oil prices have stabilized, rubber prices too have been stable, but at the same time, CJ, I can't help being a little cautious about it, considering that the company earns about 1/3 of its revenues from its European operation, and things are not looking so hunky-dory there at this point in time. So maybe that could act as a cap on C8.
Well, I share your caution, Santo.
Apollo Tyres,
yeah. I share your caution, Santo, because of course, you talk about a very decent earnings show as far as Q2 is concerned. But let's not also forget that oil prices at not so long ago were about $84 to $82 per barrel. They've already come back towards 96 to 99 and now threatening almost to breach the $100 per barrel mark. So clearly, a lot of the sequential benefits in margins that the company might have seen in the second quarter may start to get negated in the third quarter, and I think that remains a big concern for me, apart from the fact that of course a good chunk of their business is coming out of Europe, and that could create troubles because the situation in Europe is expected to only get worse from here, not better at this point of time, because of the shortage in natural gas and a very strong winter coming in those regions. So I think the margin story, while it has been good in the second quarter, it will be very interesting to see if the management can at least sustain these levels in the third quarter, December quarter, and if they can improve upon it, well, then of course, holy smoke.
Well, last stock on my watch list is SJVN, which was formerly Sachlat Jal Vikas Nigam. Now, flattish set of earnings from SJVN for this quarter, but at the same time, it's a longer term story on the growing demand for renewable energy. Now, the government itself has set a target of about 500 gigawatts of renewable energy by 2030, and the theme is likely to be solar plus hydro. So, a good chunk of it is also likely to come from hydro power. So, that is one of the key arguments in favor of the stock at this point in time. Besides that, CJ, SJVN is also trying to reinvent itself as a renewable power as a service company. So, it plans to do that through fresh projects of about 1.6 gigawatts plus about another 14 odd gigawatts of what is known as a pumped storage projects, which is like basically storage of hydroelectric power. CLS and Motilal Oswal are among the brokerages which is very bullish on the company at this point in time. And also remember, CJ, one of the intents of SJVN is to supply power to the grid round the clock, and over the last 4 years its plant availability factor has been in excess of 100%, and that has allowed it to earn a return of equity of about 19% compared to the regulated return of about 16.5%. According to CLSA, DCF based price target for the company is about 43 rupees, but the stock could also double over the next 4 years.
Well, Santo, that sounds very promising, but of course promises also need to be realized, and as far as PSU companies are concerned, that track record is always very sketchy. That said, I think my concern would be, of course, on the sequential degrowth that you are seeing in the company's earnings in the September quarter. While year-on-year numbers do look decent, sequentially the company's earnings have suffered, probably because of lower demand, because it's the monsoon season, so there could be seasonal factors as well. But we'll have to wait and see if there is sequential improvement in the December quarter. At this point of time, Santo, SJVN seems to be more of a promise than execution, and investors can only hope, and of course even analysts who are now sticking their neck out, such as CLSA, that the theory does play out to the script. But of course, one limiting factor to any sort of upside to the stock will be the fact that there is a good chunk of government stake in this company, and we tend to see that whenever PSU stocks tend to do well, we always see certain OFSs coming into the market. The government also trying to utilize the good demand for such a stock to pare its stake down, as it should, of course, in the course of time. But that generally tends to hinder any sort of linear rise in stock prices as far as PSUs are concerned. You can see that in examples of Coal India, for example, recently, or IRCTC for that matter of fact. So although the story is good. It looks, there is a lot of promise, but I think execution will be key to sustained performance from this company. Well, Santo, moving on to some of the views and queries coming in from our viewers, and Nikhil Subhash Santo interestingly wanted to know our thoughts on HDFC.
Well, again the same thing, because it's at some point it's likely to be merged. It will be merged with HDFC Bank. So
yeah.
its price movement will always be linked to that of the performance of HDFC Bank. Now that the share swap ratio has already been agreed upon, so I'm not sure whether you can look at it in isolation at this point. And there may be a brief trading opportunity if, for instance, let's say HDFC Bank shares spike. HDFC shares will also move in the same proportion. So at best, I would say trading opportunities.
Absolutely, because I mean, as far as expectations are concerned, Q1 of FY24 is when people are expecting for the completion of the merger between HDFC Bank and HDFC. So therefore, even though earnings momentum for HDFC has been decent, if you look at their individual loans growth, that has been what has been driving the business the past 1 year, and earnings have been decent so far as far as HDFC is concerned. But as Santo mentioned, its fate is now linked to what happens to HDFC Bank than in its own hand. Another question, Santo, coming in from our viewer. Oh, where did it go? Yes, of course, Mitesh Rane. He wanted to know our thoughts why Nykaa has been falling even after being profitable.
Well, CJ, I think you should begin, and then
probably. No, I want to know your thoughts on that. Why is Nykaa falling despite being profitable? Because against all newish tech companies, the first argument that people say is it's a loss-making entity, so why should it not fall? But why is Nykaa falling?
Well, Mitesh, I think probably it could have partly to do with the fact that profits are a good thing, but then the valuation and the profit must have some connection. How much does the company want to value a company? How much does the market want to value a company based on the kind of money that the company is making? So when market sentiment is quite upbeat, investors are willing to pay any valuation. But when market sentiment turns cautious, there are other opportunities around, then investors again take a hard look. And in the case of Nykaa, at this point probably they feel that the kind of profits that it's making does not justify the huge valuation. So valuations are what, 100x forward, and revenues and profit may not be growing at the same time. Remember, it's also a very intensely competitive field, which means that earnings will be slower to come. Nykaa will have to make a lot of investments as well. So it's that means a slight drag on profitability, at least in the near term. So that could be one of the reasons perhaps investors are shying away from Nykaa at this point.
Well, also Mitesh, in the very, very short term, of course, you would have read it probably on the internet as well, the fact that there are certain pre-IPO investors of Nykaa who are now allowed to sell their shares in the market because their lock-in period post the IPO has ended recently. Now, what that does is that because a lot of these pre-IPO investors say bought Nykaa when Nykaa was an infant child, so therefore their acquisition cost of shares was very, very low. So
as low as in some cases even less than 10 rupees.
Less than 10 rupees. So for them, even though Nykaa is available at say 200 rupees right now, it's 10x growth or 10x returns. So they will of course be enticed to probably take some profit booking, and that of course worries market in general when such a chunk of supply comes. Also at a time when the sentiment for the stock has not really, or the sector at large is not really that great, and that can have the possibility of depressing prices going ahead. I think, Santo, we can wrap up the show. We are running out of time, so we'll probably be able to take only 2 thoughts, but of course we'll continue to keep on adding your thoughts and your queries into our show going ahead, so do watch out for subsequent episodes.
Well, and with that, we wrap up this edition of Market with Santo and CJ.
And guys, keep following us on the social media links that you can see at the bottom of your screen. And of course, for all your financial news, stay tuned to moneycontrol.com and download the Moneycontrol app. We'll catch you again live at 3 p.m. Till then, have a great trading day.